Hey, what's going on, guys? This is Alex, aka Blood Phantom 81. Thank you for checking into my channel. Today, I want to talk about my first option, which was actually a put option, and I want to talk about the whole experience because I'm just learning what options are like, and I kind of want to get good at options. Like, I think that's a good direction to steer my account in, at least like a little bit. Options are a great way to leverage yourself and protect yourself and things like that. So it's something that I want to get good at, like I said. So I figured I'd start pretty small. And actually, on Friday, I bought my first put option, and I actually sold it today. So Friday was, obviously there was a trading day. Monday there was no trading day, and then today was the first trading day since my option. I immediately sold it right when I woke up because I was up around 95% on this option. So pretty cool stuff. Let me go ahead and show you guys the transaction. So this is buying the put. So I also want to explain a little bit what options are, because I'm learning it for the first time too. So maybe it's helpful to hear it from someone who's just barely learning it. So basically, you buy the right. You're paying for the right to buy or sell a stock at a certain price. However, this option, the value of the contract, actually fluctuates kind of like a stock, depending on the underlying stock price itself. So on Friday, the QQQ was about, I want to say maybe 165 when I bought this option. So I bought this option when QQQ, which was the ETF that I bought the put option for, QQQ was at 165. And so I bought a put option with a strike price of 164. Now, what that means is, excluding the premium, which I'll go ahead and explain later, what I'm saying is I'm making a bet that QQQ will get to 164 or lower by a certain date. That date was 125, which was on Friday. So basically, I bought an option on Friday that would expire the week after. Now, what happens if it expires and the price of the stock or the ETF that you're buying the option for doesn't actually hit your target price? So if that happens, you're at risk for losing the entire contract, basically losing everything that you put in. So that's why it's very important to only put in what you're willing to lose. Obviously, we hear that with regular stock trading, but with options trading, it's a lot more risky. At least that's something that I'm learning. So had this ETF not gone to the price that I thought it would go, then I would have lost everything. So that's exactly why I started small. This option costs $113 to purchase. And then, like I said, this morning, which was 12 hours ago, I sold the entire contract for about $100 more. So that's pretty much like a 90% return in like literally a matter of like maybe 2 trading hours. So pretty crazy how that happened. I think the one huge takeaway here is to not get carried away with the potential of options. Actually, kind of a reason why I didn't get into options earlier was because I kind of know myself, and it's just such a rush to have that much leverage. I just want to make sure that I'm going to be careful going forward, and that's the lesson that I want to give you guys, is definitely be careful when you're doing this stuff. So I hope that I'm going to be responsible going forward. As it stands right now, I figured I'll dedicate maybe like $1,000 or something to options trading. And so whatever I make with that $1,000, I'll keep reinvesting it and so on and so forth. So right now I have about $39 in buying power. And so that's kind of where my head's at. As far as why I bought the option, well, the candlestick on Friday looked like a reversal candlestick. As you guys can see, this is somewhat of a doji candlestick. And if we zoom into the 1 hour time frame, RSI was definitely way overbought. So RSI was around here at 78, and it just felt like this entire move was pretty overextended. So I bought the option right there. And the price that I thought it was going to go under or go to was around 164. So that's the option that I paid for. However, with the premium, and premium means the price to actually buy the option itself, in order for me to break even, then the stock price had to go below 162 or something like that. So you have to take into account that margin of error, because it does take money to actually buy these options. One kind of segue I want to get into is, if you think about options like insurance policies, then it becomes very clear. So basically, let's say I was investing all my money into stocks, but I had a little money just for these options. And let's say, next week I felt like the stock market was going to drop a lot. So I wanted to protect my investment. What I would do is I would buy, let's say, a put option with a certain date of expiry. And how much I pay for the option will differ depending on how long I have the coverage for. So if I have the coverage for a week, it's not going to cost as much as the coverage for 2 weeks, just like insurance that we're all used to. And then the other thing that you're paying for, aside from the time, is actually how much coverage you're planning on getting once the stock price hits your target price. So obviously, we know that from experience with paying maybe car insurance or home insurance. If you want more coverage, then you're gonna have to pay for more. So basically, the less aggressive that your option is, for example, let's say QQQ was at 165. So QQQ going to 164 is a lot more likely than QQQ going to 162. So you also have to pay for the amount of coverage that you're going to get and the likelihood of that actually happening. So that's something that I want to cover. So yeah, basically, you're paying for three things. You're paying for the time that you're getting for that thing to actually happen. You're paying for the probability of that thing actually happening. And the other thing you're paying for is coverage. So if you want to get more coverage, then you'll buy more options, and it's going to cost more money to do that. So yeah, I think that's actually all I want to talk about. Maybe I'll do a brief stock market overview. Why not? So basically, nothing has really changed. So this is the rising wedge that I was talking about last week. We have broken below this rising wedge. As you guys can see, this red candlestick right here, the high is near this green support line. So clearly broke below it. Let's go ahead and zoom in a little bit. And now it's just sort of been kind of like a free fall. So yeah, so on SPX, actually, it's a little different. So we did show some support here at the 50-hour moving average. So it's possible that we go and have a small bounce. But I think it's going to be a little difficult to get above this green trend line once again, because now that it's broken below it, this green trend line will now act as resistance. Hopefully, at least, yeah, that's what I'm hoping for. So hoping we get rejected here once again. And then places that I'll be a buyer at are this green box. And so the reason why I chose this green box was because that's where the 0.618 and 0.5 retracements sit. So that'd be an ideal place for a wave 2 after this wave 1. So wave 1, wave 2, and then wave 3 will be a huge bounce. So for those of you that follow Elliott wave analysis, that's kind of what I'm looking out for right now. So you guys get that update for free. But anyway, so that's pretty much all I want to talk about. Just waiting to get comfortable with the stock market once again, and I'm going to be experimenting more with options. So my account could either blow up in my face, or it could do really well. We'll see. I'm going to hope to be responsible going forward. But anyway, that's it for this video. Hope you guys have a great day. Hope you guys learned something. Let me know if you have any questions about options. I'm very new to this too. But with all that out of the way, have a great day, great week, and see you guys on the next video.